You know those classic slapstick cartoons where a character has one foot in a rowboat and the other foot is in a second rowboat?
Oh, yeah, and the two boats are very slowly drifting apart.
Right. And you just sit there watching the tension build, knowing that eventually, I mean, physics has to win, and someone is going straight into the water.
Yeah, the structural integrity of a cartoon character can only handle so much stretching. Something eventually snaps.
Exactly. And that cartoon is the perfect visual for the source material we are diving into today. We're looking at a pre-market research report from today, Tuesday, August 11th, 2026.
And the defining characteristic of the global economy right this second is this massive, agonizing stretch.
Yeah, it really is. We've got one foot anchored in the heavy physical reality of old-school geopolitical conflicts, volatile oil, and, stubborn inflation.
Right, while the other foot is strapped to a rocket ship, attempting to build a $500 billion futuristic tech infrastructure that seems completely detached from the physical world.
It's wild. It is a profound tug-of-war between the old economy and the new economy. So, our mission for this deep dive today is to figure out how these two completely different realities are coexisting, the mechanisms driving them, and ultimately, which boat is going to pull the other under.
Because one of them has to give.
Exactly. And you can see this tension immediately just by looking at the global mood this morning. I mean, we aren't going to just read a list of numbers, but the heat map at 8 a.m. Eastern Time tells a story of pure confusion.
Oh, absolutely.
Over in Asia, you've got the Kospi in South Korea up slightly, mostly because of a bounce from Samsung. But then the Hang Seng in Hong Kong is down.
Yeah, it's mixed. And the Nikkei is closed for a holiday, so we don't have that data point.
Right. And Europe is essentially holding its breath, trading flat across the board. The only things showing aggressive life in Europe today are energy companies.
Which, is the immediate symptom of that old economy anchor we just mentioned.
Yeah.
While the market loves to obsess over the shiny object of technology, the undeniable main character of the global economy today is oil.
It always comes back to oil, doesn't it?
It really does. We are looking at Brent crude sitting just above $89.01 a barrel, and WTI crude is at $83.54.
Those are really aggressive upward moves.
Yeah, Brent is up 1.5%, and WTI is up 1.7% just this morning.
So the catalyst for that spike feels like it was, I don't know, ripped straight out of a Cold War history book.
It really does.
The U.S. Iran peace talks have basically ground to a halt. The research report actually describes it as a Mexican standoff.
Right.
And just to outline the facts impartially based on our sources here, President Trump has introduced new demands for compensation into the negotiations.
Which is a major shift in the dialogue.
Yeah, it is. The immediate result is that the talks have totally stalled, and the market is suddenly pricing in a severe threat, which is a prolonged closure of the Strait of Hormuz.
And the geographic and economic importance of the Strait of Hormuz is almost impossible to overstate.
Paint a picture for us. How critical is it?
Well, it is essentially the jugular vein of the global energy market. We are talking about a narrow stretch of water that facilitates roughly 20% of all global liquefied natural gas and oil flows.
20%. That's massive.
Exactly. 1/5 of the world's energy supply relies on that single passage staying open.
Wow.
So when negotiations break down and a closure becomes a tangible threat, the market doesn't just wait to see what happens.
Right? They act immediately.
Yeah, it prices in the risk instantly, which is why the research desk is noting a very real trajectory for Brent crude to hit $100 a barrel if this impasse holds.
Let's trace the mechanics of that, because for a lot of people listening, a geopolitical standoff in the Middle East feels a bit abstract. It's just news on a screen.
Sure.
But an oil spike doesn't just stay in the energy sector. It bleeds into literally everything.
Yeah, we refer to this as a geopolitical tax.
The geopolitical tax. I like that phrasing.
Yeah, when crude oil and European natural gas surge, the impact is structural. Energy is the base input for the modern world. Think about the second and third order effects here.
Like what?
Well, an airline doesn't just absorb a 30% increase in jet fuel, right? They rewrite their pricing algorithms, which means your next flight costs more.
Right.
And retailers, they rely on diesel to move goods from ports to warehouses to store shelves. When logistics costs spike, they pass that directly on to you, the consumer.
So it's a tax you don't even vote on, but it gets quietly added to your grocery bill, your winter heating bill, your Amazon deliveries.
Exactly. And that invisible tax creates an absolute nightmare scenario for central banks, which actually brings us to the upcoming Consumer Price Index, or CPI print, tomorrow.
Right, the big inflation data drop.
Yeah. Central banks use interest rates to cool down demand. The theory is if borrowing is expensive, people buy less and prices fall.
Makes sense on paper.
Right, but you cannot use interest rates to fix a blocked strait in the Middle East.
Yeah, higher rates don't clear cargo ships.
Exactly. If a geopolitical tax artificially inflates the price of goods across the entire supply chain, it muddies the CPI data. The central banks are trying to read the economic temperature, but the thermometer is like being held next to a fire.
Which means central banks are essentially flying blind into the next few months.
Pretty much, yeah.
So if we follow that thread, this massive inflationary pressure from energy, we have to look at how the actual gears of the economy, Main Street, are handling the pressure.
And right now, the benchmark for the cost of money, the 10-year Treasury yield, is anchored at 4.66%.
That followed some softer payroll data earlier in the week, right?
Yeah, but that 4.66% yield is still the gravitational pull of the entire financial system. It dictates the cost of corporate debt, auto loans, and crucially, mortgage rates.
It is a highly restrictive environment designed to squeeze the economy.
Definitely.
But the data we got this morning is incredibly contradictory. At 10 a.m. Eastern, the July NFIB Small Business Optimism Index dropped. The street expected a reading of 96.8.
And what did it come in at?
It actually came in at 97.4.
Oh, wow.
Yeah, small businesses are beating expectations. They're showing surprise resilience, despite the fact that money is incredibly expensive to borrow.
That's fascinating. It suggests that the underlying engine of the economy is still running pretty hot-ish,
Yeah.
Small business owners are finding ways to maintain margins, maybe by passing costs along or operating more efficiently. But you really have to contrast that optimism with the housing data.
Right, because also on the docket today is the July existing home sales report.
Yeah, and that is expected to dip to 4.05 million from 4.09 million.
Let me push back on how we interpret this, though, because looking at those two data points side by side feels like a total paradox.
It does.
We have resilient, optimistic small businesses operating in an economy that is ostensibly healthy enough to beat forecasts. Why should we care if existing home sales are stalling? Doesn't that just mean capital is flowing into business operations instead of real estate?
It's a great question, but it's less about capital flowing efficiently and more about structural paralysis.
Okay, how so?
The housing market is experiencing what we call a lock-in effect or golden handcuffs.
Oh, because of the old mortgage rates.
Exactly. Millions of homeowners secured 2 or 3% mortgage rates years ago. With the 10-year yield where it is today, buying a new house means taking on a 6 or 7% mortgage.
Ouch. Yeah, no one is doing that voluntarily.
Right. No one is willing to trade a cheap debt asset for an expensive one, so inventory just completely freezes.
So housing is paralyzed by the math, whereas small businesses are just forced to adapt daily to survive.
Precisely. And this paralysis versus resilience dynamic is a global headache. Just look at the Reserve Bank of Australia today. Yeah. They held their interest rates at 4.35% today in what analysts are calling a hawkish hold.
A hawkish hold, meaning they didn't raise rates, but they aggressively signaled that they are perfectly willing to do so if inflation flares up again.
Exactly. Central banks are basically trapped.
It's a staring contest. I mean, if the Federal Reserve in the U.S. looks at small businesses beating optimism forecasts, and then they look at the Strait of Hormuz threatening to slap a geopolitical tax on the global supply chain, a September rate cut suddenly looks incredibly risky.
Yeah, the market has been treating a September cut as a given, but if the economy is too resilient, cutting rates could pour gasoline on the inflationary fire.
It changes the September cut from a certainty to a coin toss.
And when the macro environment is this uncertain, with central banks paralyzed and oil threatening to spike, investors look to the micro level.
Right, zooming in.
Yeah, they look at individual corporate behavior to see who is actually surviving the pressure cooker.
And this is where the story gets really fascinating, because corporate earnings are telling us exactly how the consumer is coping. Let's look at On Holding.
Ticker symbol ONON.
Yep, ONON. The premium athletic shoe and apparel brand. They are surging 8% in the pre-market today because they absolutely dismantled their Q2 estimates.
I saw that. Net sales grew 13.5% to over 850 million Swiss francs.
And their net income skyrocketed by more than 350%.
Which is insane. I mean, in an environment where the cost of living is supposed to be crushing discretionary spending, a premium sneaker brand posting a 350% net income surge is a massive anomaly.
Yeah.
It requires us to completely rethink our assumptions about the consumer.
To me, it highlights the phenomenon of the barbell consumer.
Yeah, barbell consumer.
Yeah. People are getting squeezed by the cost of groceries and gas, so they're trading down to generic brands for everyday items.
Yeah.
But they are fiercely protecting their spending on specific high-status or high-quality items that they care about.
Oh, I see.
Like, if they want those premium on running shoes, they will just eat out less for a month to justify the purchase. The consumer isn't dead. Their spending has just become highly concentrated and ruthless.
That is a great analogy. It's like a runner sprinting uphill, right?
Exactly.
And that behavioral shift is keeping retail resilient.
Yeah,
But consumer confidence does not necessarily translate to boardroom confidence.
that's very true.
While everyday people are still buying premium shoes, massive multinational corporations are looking at the 4.66% yield and getting major cold feet.
Yeah, the research report highlights a massive development in the mergers and acquisition space regarding AstraZeneca and Bristol-Myers Squibb.
The rumors of a $400 billion mega merger.
Just an astronomical number.
Yes. To contextualize that, $400 billion is roughly the GDP of South Africa or the Philippines.
Wow.
Yeah, merging two pharmaceutical titans at that scale requires a mountain of debt financing. And according to the latest notes, AstraZeneca's board may be walking away from the table.
And the market is reacting. AZN shares slid 9% on the news, reflecting deep investor skepticism.
Right. And mid-August remains the critical announcement window, but it's looking shaky.
The report specifically uses the phrase deal fatigue. Walk us through the mechanics of that, because why would a deal that made strategic sense a month ago suddenly collapse?
Well, it comes back to the staring contest we discussed earlier. A merger of this magnitude requires absolute certainty.
Right.
You need to know what your debt is going to cost over the next 10 years to model your returns. If the Fed is trapped and rates might stay higher for longer, the cost to service the billions of dollars in debt required for this merger becomes exorbitant.
And then you add in the geopolitical instability.
Exactly. The board realizes the margin for error is zero. The financial gravity of the old economy, high yields and expensive oil, is successfully killing one of the largest corporate marriages in history.
Although it is worth noting that gravity only applies to certain sectors. The report does mention Healthy Choice Wellness, ticker HCWC, merging with Host Digital Infrastructure, which sent their stock up roughly 60%.
Yeah, but that is a tiny fraction of the scale of the pharmaceutical deal. The massive scale of the debt is the poison pill there.
Right, scale is the differentiator in traditional markets. But there is one sector that seems completely immune to these physical and financial constraints, operating entirely by its own rules.
Ah, yes. The other rowboat.
The other rowboat. While retail, housing, and pharma are carefully tiptoeing through a minefield of high rates and geopolitical standoffs, the tech sector is just building an alternate universe.
Completely ignoring gravity.
Let's look at the indexes. The tech-heavy NASDAQ 100 is up 0.4% today, leading the pack, while the broader S&P 500 is barely up 0.1%, and the Dow Jones is flat.
Right.
But the index movement is just the surface. The real story today is Nvidia.
Nvidia. They have been the poster child of the AI boom, primarily as a hardware vendor selling the graphics processing chips that make artificial intelligence possible.
Right.
But the development in today's report changes their fundamental role in the global economy entirely.
This is wild. Nvidia's finalizing a $500 billion financing package.
$500 billion.
$500 billion. And they aren't raising this in public markets. They are partnering with private equity leviathans. Blackstone, Apollo, KKR.
The heavy hitters.
Yeah. The stated goal of this war chest is to fund global AI infrastructure.
This is a seismic shift in the narrative. For the last 2 years, the AI story was mostly about software companies buying chips.
Right, just buying components.
Exactly. What this private equity deal signifies is a transition from buying components to building the physical cities that will house the future of the internet. Wall Street private capital is going all in on the Nvidia ecosystem.
Let's unpack the reality of that infrastructure, because cloud computing and AI, they sound so ethereal and invisible.
Yeah, they sound like magic.
Right, but a $500 billion private equity deal means they're buying concrete, steel, and land.
Oh, absolutely. Artificial intelligence is incredibly physical. To train and run next-generation AI models, you need data centers the size of several football fields.
Wow.
And those facilities require specialized liquid cooling systems because the servers run so incredibly hot.
Right.
They require massive tracts of real estate, usually near major fiber optic trunks. And most importantly, they require a staggering, almost incomprehensible amount of electricity.
So private equity firms like Blackstone and KKR are not venture capitalists just throwing money at a software app. They are infrastructure builders.
Yes. By partnering with Nvidia, Wall Street is treating AI data centers the same way they treated toll roads, bridges, and power grids back in the 20th century.
That is fascinating. But I look at a number like $500 billion deployed into physical data centers, and I have to ask, are we essentially pre-building empty digital cities?
What do you mean?
I mean, is Wall Street laying down the necessary foundation for a multi-trillion-dollar technological shift? Or is this the ultimate peak of an AI bubble? Like, what happens if they build $500 billion worth of infrastructure and the commercial demand for AI software doesn't grow fast enough to pay the rent?
Well, it is the defining gamble of our era. The closest historical analogy is the telecom boom of the late 90s.
The dot-com era.
Exactly. During that bubble, companies spent hundreds of billions of dollars laying fiber optic cables under the oceans and across continents, anticipating this massive surge in internet traffic.
And when the bubble burst, a lot of those companies went bankrupt because the demand just wasn't there yet.
Right, the investors got totally wiped out. But, and this is the crucial part, the physical fiber optic cables remained in the ground.
Oh, interesting.
So when consumer technology finally caught up a decade later with smartphones and streaming video, that pre-built dark fiber became the backbone of the modern digital economy.
Oh, wow. So Blackstone and Apollo are betting that AI infrastructure is the new fiber optic cable.
Precisely. Even if the software companies stumble in the short term, the physical utility, the data center, will be an absolute necessity for whatever comes next.
So for anyone listening to this deep dive, the real takeaway is that your future digital experiences, software, and tools are literally being underwritten today by this historic private equity war chest.
Yep. The artificial intelligence that will eventually manage your company's logistics or design your medications or drive your vehicle, it requires a physical home, and the titans of Wall Street are pouring $500 billion into pouring the concrete for it right now.
They are building the new economy at a breakneck pace. But, as we discussed at the very beginning of the show, that new economy doesn't exist in a vacuum.
No, it shares a planet with the old economy.
Which brings us to the perfect synthesis of these sources, the collision of our two rowboats.
Yes.
On one side of the ledger for August 11th, 2026, we have the heavy, restrictive anchors of the real world. A Mexican standoff in the Strait of Hormuz threatening to choke off 20% of global oil.
A geopolitical tax poised to wreck the inflation data.
Central banks completely paralyzed by sticky 4.6% yields, freezing the housing market and killing $400 billion pharmaceutical mergers.
And then, on the exact same day, on the other side of the ledger, we have a $500 billion private equity mandate to build the most advanced, power-hungry technological infrastructure in human history, just seemingly ignoring the macroeconomic gravity that is holding everyone else down.
It's unbelievable. But there's one final detail in the economic calendar of today's report that ties these two worlds together in a really provocative way.
What's that?
At 11 a.m. Eastern today, the EIA, the Energy Information Administration, is releasing its short-term energy outlook. The research desk specifically notes this report is crucial for tracking how the government views the potential supply disruption from Iran.
So it's basically the official scorecard for the geopolitical tax.
Right. But I want to leave you, the listener, with this thought to mull over as you watch the markets open and watch these massive AI data centers get built. We just established that the AI revolution requires an unprecedented exponential increase in physical electricity. You cannot run a $500 billion network of Nvidia chips without massive continuous power generation.
No, the grid demands are going to be staggering.
So if the frictionless, futuristic world of artificial intelligence relies entirely on a massive surge in energy, and traditional global energy supplies are constantly threatened by old-world geopolitical bottlenecks like the Strait of Hormuz, could the ultimate ceiling for the AI boom actually be old-fashioned real-world energy constraints?
Wow, that's a fascinating paradox. The digital utopia being built by Wall Street might ultimately be bottlenecked by a cargo ship trying to navigate a narrow strait in the Middle East.
Exactly. The new economy literally cannot escape the physical limitations of the old one.
It's the ultimate reality check for the tech sector.
It really is. Keep that tension in mind as you navigate the news today. Thank you so much for joining us for this deep dive.
Yeah, thanks for tuning in.
Understanding how these massive, seemingly unrelated forces, from a premium sneaker brand beating earnings to a collapsed pharmaceutical merger to a $500 billion bet on data centers, are actually deeply connected is the absolute key to staying well-informed. Keep asking questions, keep pulling on these threads on your own, and we will catch you on the next deep dive.